Good afternoon, everyone. This is Tim McCusker, Chief Investment Officer at NEPC. Thanks for joining us today and excited to have this discussion. This is our 10th annual Investment Manager webinar, as you see here on the page. Crazy to think that we've been doing this for 10 years, although I guess the last 3.5 weeks feels like it's been about 10 years, so maybe not so crazy after all. I want to start by saying thank you to all of you on the phone, all of our investment manager partners. You guys have been great over the last few weeks. We've asked a lot of you so that we can get real-time information to our clients, and you've been awesome about that. Whoops, what just happened there? Sorry about that. Looks like my screen is showing something funny all of a sudden. There we go. Sorry about that. You have been great about sharing information with us, getting it to us quickly. We've asked for quarter end information really quickly, and you've all turned that around. So we really appreciate that and think that it makes all of us look good with our clients. And it aligns really well with the goal that we have in working with all of you. And so to work constructively, to find great ideas, get them into our client portfolios so that our clients can meet their objectives and we can all look good. We can all help in helping them to meet their objectives. So today I'm joined by Sarah Samuels, our Director of Marketable Securities, and Tim O'Connell, our Director of Public Markets. I'm going to kick off with just a quick NEPC update and a market outlook. Sarah will take you through some of our key initiatives. Tim will go through our coverage and process, and wrap up with manager search activity, which I know is always interesting to everyone to find out where we're putting money to work. We'll bring some final thoughts and then leave some time for questions at the end. So little has changed at NEPC, and I think that's a really good thing. We're close to 300 employees with 296 regional offices right now. Hopefully we'll be getting back to those 8 regional offices before too long. We continue to be entirely employee owned with 44 partners. And we believe we continue to stand out as the most diversified consulting firm in the industry. And we're really proud of having those leading businesses in each of those spaces. We think it makes us a better consulting firm to know what's going on across the entire landscape. And we think it makes us a better research team too, to understand what's going on in corporates, what are they doing with LDI, what are endowments and foundations doing in the private market space or in ESG, what are public funds and others doing from a diverse manager perspective. We can cross-pollinate those ideas, and I think it's an important differentiator for us as a business. Our focus remains the same as well. We want to go to each client and have them feel like they're our only client. Have them understand that we bring segment expertise, we bring unique ideas to them that really are customized to meet their needs, while having the resources available to bring them a full suite of services. And that means, from a manager research perspective, providing both breadth, knowing the universe of managers that are available to us in any space, but also the depth to go deep and know those managers really, really well. And that is completely unchanged for us. So little change, just continuing to be who we are. I think we've been really happy with how we've moved to a work from home setup and have had great continuity there, and the team is working really well in that approach. From an outlook perspective, I'll spend a few minutes talking about investor needs and what we're seeing on that front, and then our current market outlook with these rapidly changing times around the coronavirus. So first, just some thoughts on what's happening with clients. You can see here the Greenwich Associates survey, which comes in the fall. I think it's kind of interesting here that you're seeing a lot less focus on risk management, a little less concern about funding issues and rate of return. Maybe back in the fall, this was an initial sign of complacency. I would expect a lot of this to flip around with the downturn that we've seen. A lot of public funds were already in treacherous funding situations, and with an asset drop, they're going to be even more challenged. E&Fs with high spending rates will be challenged as well. I think a lot of the corporates are going to be doing okay with as long as they had some sort of hedging approach in place already. But I expect some major changes here just because of the last few months. If we turn to where we're seeing activity, and this question is where allocators expect to have activity, this is very consistent with what we're seeing. We're seeing a continued move towards passive, and you can see that with U.S. equities expected to continue in the active space to continue to be decreased. And the big numbers that jump off of the page are private equity and private debt, with very few expecting to decrease that allocation and most expecting to increase. Now, that could definitely change with market moves and the denominator effect. We would expect that clients will work through that and continue to commit to those spaces, just given that the return expectations are so much higher there. From our perspective, the outlook that we're sharing with clients right now is, I'd say, a fairly straightforward one. Because there's so much uncertainty, we want to stick with some basic risk management principles that we think are important for long-term success. The first is to stay diversified. Being diversified has been very beneficial the last few weeks and throughout this year. And that's on the heels of a year in 2019 where it was disappointing to be diversified. That the market punished the prudent. If you didn't have all U.S. equity exposure, if you weren't up 30+% like the S&P 500 was, you were disappointed. We're now seeing the benefits of diversification, having some balance in the portfolio, having some treasury exposure that can be positive as your equities and credit are selling off has been really important. With that, we think even in these uncertain times that it's important and critical to be rebalancing towards targets. We've added to that, saying that we also have to be careful about transaction costs. So that has certainly improved over the last few weeks. And many of you in the fixed income world have been great about sharing your commentary and on the ground insights about liquidity and trading. So thank you for that. But we do think it makes sense to rebalance towards targets. We don't think that we can call the bottom, and think that that discipline of rebalancing is the best way to approach this right now. We do think that there's going to be really interesting opportunities out there. We think it's early to be moving on those opportunities, but we've rerun all of our assumptions and we'll be rolling those out in the next week to our clients. And we see an even bigger delta between equity expectations and treasury expectations, between credit and treasury. So we think there will be an opportunity to take some additional risk. We also think there will be great opportunities in distressed over time, but early on that as well. We also think, just given the uncertainty, we saw that in the first few weeks of this crisis, the Fed has stepped in and really liquefied markets, so it's less of an issue. But given that things can change on a dime, we want to have clients being really careful about liquidity and potentially raising a quarter's worth of cash needs, so they don't have to go to it in the most dire times to sell something that they don't want to. So you hear some things in there. If you're a fixed income manager, you may be looking at redemptions, and probably already are, as clients look to rebalance, and allocations across the portfolio may need some trimming to raise some cash in the near term. We say all that just being humble that we're struggling with a lot of this. We see the widest range of outcomes that we've ever seen in the potential path forward for the economy and for markets, and we're trying to lay out how this can move forward. Could it be a real downside scenario where we see a depression-like outcome, where the loss of income just cascades through the system and we can't get out of it? We think that's less likely with the policy response that we've seen, but we have to take it into consideration. A deep recession is probably pretty likely at this point, and calling that bottom is really hard. So we think rebalancing toward targets makes sense, and that's sort of our base case right now. And then there's always the possibility with the policy response, with the actions that have been taken with mitigating the coronavirus, that we see a sharp recovery and a V-shaped type outcome. And in that case, we'd want to be increasing targets. We don't think we're there yet, and think it makes sense to rebalance towards target right now. So our expectations that we're sharing with clients right now is that we're going to see some pretty shocking economic statistics. We're likely to see some additional policy responses, and those characteristics that I laid out just a couple slides ago of being diversified, disciplined, dynamic, and having some dry powder for safety are the important characteristics that will lead to success over the long term. So I'll pause there and I'll turn it to Sarah to go over our key initiatives.
Great, thanks, Tim. Hi, everyone. So it's been about a year since I joined NEPC, and it's been a really great time getting to know all of you as I've been here in this first year. When I joined, I spent a lot of time sort of focused on our investment approach and understanding how we do what we do. And the great news is that we do things really well here. We have a very solid investment approach. What you're going to see going forward is probably some enhancements to the investment approach, us going deeper in a couple of areas of our diligence process. Tim O'Connell is going to talk a little bit more about that in a moment, but it's going to involve going deeper in some quantitative areas, understanding a little more about how you're generating the returns that you are, and also diving into firm ownership, alignment of incentives, and succession planning. So those are some things you should expect to see from our research team in a little more depth going forward. Tim's also going to be talking about a ratings approach, a ratings system that we have implemented. It's an evolution, not a revolution, but what this is going to allow us to do is to have some more transparency into our due diligence rating scores and some more, a little bit more of a formalized approach. As a result of this new investment framework, it is possible and likely that we will have some downgrades of investment strategies as a result of this more detailed framework that we're applying. And so that's just something to keep in mind. This will be organic and just as we go through the process. There's no top-down mandate to cull our FPL list or to reduce the number of managers that we have exposure to. We're also pleased to share the new coverage approach that we have for our team. So historically, you've all known which researchers to get in touch with, depending on the asset class that the researchers cover. Earlier this year, we created what we're calling a client strategy coverage team. And this is a team that's dedicated to overseeing the diligence of our 3, 4, and 5 rated strategies. This team is composed of Steve Gargano, John Shanklin, and Istvan Mezaros. So if you have if your strategy is rated 3, 4, or 5, you should expect to be working with those 3 gentlemen. And then going forward, the researchers that are shown on the org chart, which Tim O'Connell will go through in a moment, will be responsible for all of our 1 and 2 rated strategies. Also, as part of our diligence process, you should expect to be receiving a DDQ. All managers that we interact with should expect to receive a due diligence questionnaire throughout the course of 2020. We're doing these in batches, so if you haven't received one yet, don't worry, you're definitely on the list. And we thank you for completing these due diligence questionnaires in a timely manner. It's really helpful for us. And then finally, another change to the way that we're doing what we do is that we are going to be taking a more nimble approach to incorporating new ideas and finding new investment strategies. Historically, as many of you know, we've reserved new ideas for our annual or semi-annual netting and vetting process. And we've really sort of said, you know, hey, we might be interested in your strategy, but hold on, wait a few months until we bring this asset class through netting and vetting. Now we'll be evaluating new ideas on an ongoing basis going forward. With that said, we really appreciate your understanding if an idea or a strategy is just not a priority for us. We appreciate you kind of hearing us if we say no, not at this time. If you turn to the next page, NEPC is very focused on fees, as are our clients. We know that you in the asset management community are feeling the fee pressure as well. And And so we are spending a lot of time, as we have for many years now, making sure that we are partnering with managers to find fee structures that work for both the investment manager and for our clients. We want to make sure that we provide reasonable compensation to investment managers so that you can run your business effectively. But we also need to make sure that when when investment managers do well, our clients do well, and that our clients are able to outperform their benchmarks net of fees. Fees can be a big tax on alpha. So we've listed here a few examples of fee propositions and alternative fee structures that we've used with managers. This is something that we'd be very open to talking about with some of you, and you may hear from our researchers. Many of you have been incredibly helpful in working with us to get our clients more favorable fees. We have roughly 150 strategies that have preferential pricing for NEPC clients. The next page shows these fee discounts by asset class, or I'm sorry, by team. So we've got the most fee discounts in the public markets, formerly known as the traditional team, as well as in our private markets and hedge fund portfolios. So one of the initiatives that we're really excited about that we've decided to focus our efforts on in a renewed way in the last year is our diverse manager initiative. We have a renewed approach. We've always been focused on diverse managers, but last year we held a diverse manager day in September, and we invited a number of managers to come and learn about how to best engage with NEPC. We really want to make sure that we're evaluating all managers and giving a good look at every manager out there. And it's really important to us to be able to be responsive to diverse managers and include them in the running and evaluate them. So we've put out publicly a couple of targets to show how committed we are, and we will reach these targets. One is that we will seek to respond to any diverse manager request for preliminary feedback on their strategy within 3 months after initial contact. We've committed to increasing the number of meetings that we take with diverse managers by 10% in 2020. And we've committed over the next 2 years to increase the number of strategies on our FPL that are represented by diverse managers to 10% of our FPL strategies. So there's a lot of good information on this page. Sam Austin and Will Ford and Shanae Edwards and several other folks have really spearheaded this effort. They are a great initial point of contact if there are any diverse managers on the phone today that want to learn more. And we look forward to working with you all going forward. And finally, this is impact investing is incredibly important to many of our clients and certainly to us at NEPC. We have an impact investment group that focuses on this with a big focus on ESG integration. So over the last couple of years, we've begun a process to evaluate investment managers and rate strategies with an ESG rating score. And that is a proprietary system that we launched in 2018, really looking at how the firm integrates ESG into the management of the business, as well as how the investment strategy incorporates ESG. So this is something that you should expect to hear from us on going forward. In fact, there are a number of questions in that due diligence questionnaire that I referenced that are really trying to understand how you and your firm and your strategies are considering impact investing. So we thank you for engaging with us on that. It's a really important theme. So with that, I'll turn it over to Tim O'Connell, Director of Public Markets, to talk about a little more detail about our process and our coverage model.
Thank you, Sarah. And so first, I want to kind of start with NEPC's broad research organization. I think the main purpose of this slide is really to show the breadth and depth. I know many of you interact with 1 or 2 individuals on this sheet, whether that's the public markets team or the hedge fund team, but we have upwards of 60 individuals across portfolio construction, asset allocation, private markets research here. And we work together across many opportunities as a team. But I know many of you have come today to kind of get an update on where our coverage is. And so if we turn to our next slide, we've gone and highlighted specifically what each person on both public markets and on the hedge fund team covers. And so I'm going to spend a bit more time on this slide. going to spend a bit more time on this slide just to highlight some additions we've had to the team. So first, starting April 1st, Alec Rappaport joined our firm to head up our public markets research effort. So on the left side here, you'll see that the majority of our fixed income coverage, ranging from short duration credit, core bonds, high yield bank loans, to absolute return and global multi-sector, is now covered by Alec Rappaport. Alec was a great hire of ours. We spent a long time talking to him, and he joins us from Mercer, and spent almost 15 years at Common Fund. So he'll be based in Connecticut, so not at our Boston office, but we'll be interacting with him a lot. And he's a great addition to our team, even though it's only been 8 days. It's been quite a time for him to join, covering fixed income. The other addition we had in December that some of you may have interacted with was Alex Rickles. Alex joined us as a senior research analyst. He was previously at ACG in St. Louis, and he moved to the Boston area and is based in our Boston office. He will be taking over coverage of our small cap, mid cap, micro cap, and target date funds. So already he's probably interacted with a number of you, but he's our point person for basically anything smaller than US mid cap as well as target date funds. In terms of other coverage, Haley Tran continues to be based in our Chicago office and is going to be responsible for global equity, emerging market equity, and emerging market debt. John Lutz continues to be based in Boston and focused on the areas that he's covered for us for a number of years, particularly developed market, international equities, as well as our representative on ESG and thematic investing. Roseanne Halloran, who's been a member at NEPC for 20 years in various roles, has stepped up to cover US large cap and US all cap for us. I'll be helping her on some of the more unconstrained strategies, but she will be a great resource and has a lot of experience across many avenues of the firm. Brandon Jones, based in Portland, is continuing to cover municipal bonds, as well as taking on inflation-linked bonds and helping out in other credit areas. And Stephanie McMurray, who works with Roseanne, will be taking over some of our index and transition coverage. And I will continue to cover flex equity, extended equity, and our liquid real assets for the foreseeable future. And on the hedge fund side, I'll kind of leave this up for a minute so you can see where coverage lies. I won't go into that in detail, but I thought it was important for us to spend, a little bit of time here highlighting some of the areas of coverage, particularly as we've shifted from some of the people you would have typically interacted with. All right, so if we turn to the next slide to talk through our research process, I think it's really important here, as Sarah said, we have not changed our investment process. We've had some enhancements and some areas of focus, and echoing Sarah's comments, we are continuing to net and bet strategies, and we will look at opportunities as they come to us. And so we ask that you bring us your best ideas and that you come to us in a couple of ways. Expect us to say no a lot, but when we find something we like, we will work with you and run towards finding some of those opportunities. And so it's important that we source ideas from everywhere. We get them from clients, from the investment community, and we have one-rated strategies that have come through all avenues. I think the second part that I want to highlight here is that as our process remains consistent, we do use quantitative screening and tools. In a slide, I will talk a little bit more about ways that we've gone a bit deeper in some of our quantitative analysis, and particularly on some of the due diligence and debates we have internally as we spend more time debating areas that we typically covered, but now we're covering it in a deeper way. And so if we turn, I think the next slide, which is most helpful, we'll talk a little bit about our investment process and areas that we call process enhancements, or particularly really focus areas. So in the green box in the middle are many of the areas that we've always focused on and will continue to focus on, which is people, process, and philosophy. This remains unchanged. We've often worked with you and looked towards what is the investment thesis of an investment strategy and what is the edge. The two blue boxes are areas of what we're calling areas of focus. So starting on the right, Sarah alluded to this a bit earlier. We're focused a lot on firm and alignment of incentives. We're focused on ownership, culture, asset flows, and some of the more quasi-operational aspects that we view as core to the investment thesis of a strategy, but oftentimes can lead to issues, whether it's at a compensation or personnel level. And so you will continue to see, and you will see more questions from us around succession planning, and we like to have dialogue with our managers as we spend time understanding kind of their plans to distribute equity in many cases. On the quantitative analysis on the left, and this is an area where we try to focus on unpacking luck versus skill, and so there's additional attribution and other tools that we use to try to determine how much of a manager's return or alpha really comes from that skill versus luck. And so you'll see us ask for additional information, such as what are your alpha expectations for a strategy, or what are your expectations? So we look forward to continue to partner with you as we ask these questions. But I know in many cases, as we kind of roll out our investment framework, we know there are going to be a lot of questions as to, how does this roll up to our ultimate score? And so if we go to the next page, we'll talk about kind of our broad investment framework. It's important here to share that this is what we'll be showing our consultants and our clients. At this stage, we will continue to share with you the ultimate rating of strategies, and we're always willing to tell you what strategies are rated from a 1 to a 5. What we're now sharing with our clients and our consultants is a little bit deeper information. And so below our due diligence rating, you'll see that we will have an analyst opinion score. We'll look at firm and organization. We'll be scoring firms on people, resources, investment philosophy, strategy, and process, as well as performance. And this incorporates some of the aspects of the previous slide that are really important. A couple of points here. So as I mentioned, we'll be keeping this internal as we continue to evaluate these strategies. And this looks like it's only 5 categories. There are a number of categories below this. I alluded on the last slide that we'll look at firm and organization. We'll talk about compensation. We'll look at culture. We'll talk about ownership, and all of that information and underlying views kind of flows up to ultimately what is a score that we'll put across each of these categories. But it's also important to look at the rating legend on the bottom. This is the same rating legend we use for the due diligence rating. So each of these categories are consistent, and many of you may not have seen kind of the way that we talk about our ratings since we shifted to a 1 to 5 rating from our previous preferred, neutral, not recommended. And so we've included some snippets here of what we use to talk to clients about a strategy being a 1 versus a 2 versus a 3. And so in it, you can, at your leisure, read through some of this. But I think it's important just for consistency. This is how we talk about strategy ratings to our clients, and we thought it was helpful to give you some of this information. All right, so if we turn to there's really 2 final slides in my section, which, as Tim McCusker alluded to earlier, is really searches. I think it's important to share this information with you yearly. What are we seeing in the market? I think the main point from this slide is, particularly across equities and fixed income, we're not seeing a lot of changes year over year from what we're seeing for searches. And in the slide, I'll show you kind of the year over year. In US equities, we're continuing to see fewer searches, similar to the slide from Greenwich Associates that we showed earlier. More and more clients are looking at passive strategies in the US, and they're really focusing on international, global, and emerging markets. We may see some increased small cap searches, but so far this year, we have actually not seen an increase in searches with some of this market volatility, although that may change kind of as the markets calm down over the next couple of months. In fixed income, we have continued to see increased searches, particularly in the what we would call safe haven fixed income areas, and that may be a core bond replacement or clients separating some of their core exposure into some of the subcomponents. Where we've seen a real uptick, and this is consistent with really the last couple of years, is private assets, continuing to see clients looking at private equity or private debt, and that doesn't always get captured here in true search volume, but that's where we've continued to see clients looking, particularly in a lower return environment, for areas outside of what we call kind of the public markets or hedge fund strategies. And here on the last slide, before I turn it back over to Tim McCusker, is really just showing these different categories over time. And I kind of alluded to limited changes over the last 5 years. I think the assets on the top will fluctuate. If you have a large client doing a search, it can skew the numbers. So we tend to look at the number of searches on the bottom. And really, since 2014, we've seen a fairly consistent split. You may have seen a slight decrease in domestic equity, but I think it's consistent with the numbers we've seen in 2019 and likely to continue to see going forward, although with this market volatility, we're not quite sure what we'll see over the coming months. And so with that, I'd like to turn it back over to Tim McCusker.
Great, thanks, Tim. Just wrap up with a few comments on how to work with us and how we can all be best possible partners with one another. So I think a real area of improvement for NEPC in the last few years has been how we've published a ton of content and used our blog to do that. So stay on top of our views on NEPC.com, on our Insights tab. bring your best ideas forward. We want to hear about those great ideas that are out there. We really want to focus on quality over quantity. I think, if we're taking meeting after meeting, and it's not going to go anywhere across a breadth of strategies with one firm, that's not productive for anybody. Let's, if you can know where our views are, know where we see more activity, and from that starting point, bring us what you think are your best strategies at a firm, we can really do some great work together rather than just padding meeting stats. We have seen managers really step up with competitive pricing. I think it's a great opportunity for managers to differentiate in searches to show that they've got better pricing and they're offering the best possible pricing to our clients. And frankly, it makes NEPC look great with our clients that we're negotiating hard and getting them the best discounts that they possibly can. We want to be, as I've said several times, we want to be great partners with the manager community. We're not looking to eke out every last dime and have you doing work for less than it's worth. We want to be fair on both sides. So if you can come to us proactively with that and be open to the conversation when we come to you with it, we think it's going to be better for everybody involved. And then lastly, be willing to take no. There's going to be times where we're just not having a lot of activity in an asset class and it's not where we're spending our time, or we just, in our opinion, have better ideas in the space. And there can be different reasons for that, but at some point we've all got to agree that now isn't the time, and we can check back in later. And from your end, you should expect some things from us. We're going to provide you every year information on what our clients are doing, and search activity. We'll provide that anecdotally in conversations throughout the year as well. We'll give you our views on the market so you know what we're thinking. We're going to share that general framework of how we're evaluating managers so you can be prepared while not giving you every question, so that we can maintain an element of proprietary nature to what we're doing. We're going to be responsive to our meeting requests, and I'm sure you can understand that there's a lot of volume to what we're doing, so that may take some time, but we will do our best and commit to that. And then we'll give you feedback on why or why not we're moving forward at any step in the process. So we do have a bunch of questions here to wrap up. So I'm going to actually, I've found over the years that going through this, folks want the slides. What they really want is this slide and the search activity slide. So I'm going to spend a few minutes just hanging this up here as we answer some questions, and thank you. We've gotten a lot of questions coming in. And then I'll move to the search activity slide after a couple questions, so you get some time to jot some stuff down. We will, as we always do, we'll post this webinar on our website, so that'll be available to you if you want to go back and listen to it and freeze on this and get more detailed information, but I'll leave it up there for a few minutes. So to start off, a couple quick hit questions that I will answer, and then we've got a bunch more coming in. First, how do you define a diverse manager? So we are defining it as a majority owned diverse manager, so diversely held at 50% or more. That seems to be the marketplace criteria. We are also looking at 33% or more as kind of a secondary characteristic that doesn't necessarily meet the definition but meets the spirit, and we'll evaluate those on a case-by-case basis, but we're looking at the manager ownership, firm ownership as the starting point for that. And then a question on how we're handling the due diligence process in this work from home environment. And what we did right out of the gate was set up some standards across the entire research team for how we do this due diligence on new ideas in particular, because we've tended to require an on-site whenever we're looking at a new manager, and that wasn't going to be possible. So we're requiring video calls in those cases, and we're hoping to get several members of the team together on those video calls because we do think it's important to see the team interaction. And then while outside of hedge funds, operational due diligence has been largely covered by the investment team members. We are asking our ODD team to step in and do a little bit more work because we can't get on site meet the broader team and see the infrastructure. So those two parts are the enhancements to our process as we work in this environment for who knows how long, but as we're working currently. Question on the Discovery platform, a couple questions on the Discovery platform, and it's essentially, does the Discovery platform still exist? Is that still a pathway to a 1 rating? And I'll let Sarah take that.
Sure. Yes. Thank you for that question. The process that we've used for our Discovery platform is unchanged as it relates to some of the changes to the investment framework and process that we described earlier. The Discovery platform is still an excellent way for NEPC research to get access to great ideas that are either nascent firms or something that may not be suitable for every single client, or a strategy that's not totally tested in all market environments yet. And so the Discovery platform is still an excellent way to engage with NEPC and to be on a path to becoming rated.
Great. Thanks, Sarah. A couple questions for Tim here. And maybe as I'm asking this question, I'll flip to the search activity slide, because that'll be the second question here, Tim. So the first is, do you disclose manager ratings?
Yep. So as I tried to allude to, we will share the overall rating. So if a strategy's due diligence rating is a 1, 2, 3, 4, or 5, we will share that. We do not plan to share the sub ratings at this point, but we will, and we do often talk with managers to make sure that we have the same rating, or that they have the same rating that we have in our system, so that there's no confusion when talking to clients. So yes, we do share those ratings with managers.
Great. And then the second question here is on search activity. We've got a bunch of questions on details of the search activity. Probably don't have time to get into all of them right now. So if there's specific questions, feel free to follow up and we'll try to get you some more information. But this question for you, Tim, which I think is a very relevant one, is if you can break down, probably not with specific numbers, but if you can just give some flavor to that big bucket of international equity, global equity, emerging, where is the real activity underneath there?
Yep. So it's actually almost equally split across the 3, but I think the way that we categorize them, it's a little bit different based on each of the regions. So we do not have a global small cap. So all of the global searches, which range is about 40 searches, tend to be at the large cap. And I think there's often more searches as many clients pair managers of different styles across their global equity portfolio. Very few of our clients have a single global equity manager. The largest one is really emerging markets, and that is split between large cap and small cap. I think we've continued to see, either based on performance or other reasons, kind of more searches in emerging markets. And then it's about split 50-50 in international markets, more so on the EFI side as opposed to ACWI ex-US, and more in the international small cap space, which is an area we've talked about from an alpha opportunity for the last couple of years. We've seen an increase in searches there, mostly in 2018, but also carrying through 2019. So it's about 40 searches across international markets.
Great, thanks, Tim. And then one last question for Sarah, another one on our new initiatives. So thanks to everyone for a bunch of questions on those key initiatives like diverse managers, our framework. This question is on the ESG score. Do you give one ESG score and a classic investment rating score and present both, or do we merge them together into one rating?
Yes, it's a great question. So the way that we evaluate firms and strategies when we're assigning and determining an ESG score is really a pretty in-depth series of questions and analysis. And so we do present to the client that work because it's really important that they understand the nuances about how you're integrating ESG into the process. So we provide to clients a sort of separate document outlining that. When it comes to the traditional score, your overall due diligence score of 1 through 5, that is separate, but it should be noted that we do consider, when making that 1 through 5 score, we do consider the how your firm is integrating ESG as part of that. So the answer is a little bit of both.
Great. Thanks, Sarah. And thank you to everyone for joining us today. Thank you to all for the continued partnership with us and with all of our common clients. I hope everyone is staying safe and healthy in this challenging environment. Look forward before not too long to seeing many of you face to face in more normal times. So thanks so much for joining us today, and we look forward to speaking soon.